Hello, everyone. I'm Mriganka from Merkle Science. Welcome to our webinar on the institutionalization of crypto assets. Today, we're going to talk about compliance. We're going to talk about custody. And we're also going to talk about movement of institutional capital into crypto assets, of course. So I'm going to quickly share my screen and give you a brief about the webinar and Merkle Science. So today, in terms of our panelists, we have Irfan, Stephen, and Henry joining us from State Street, Fireblocks, and Fusang. So the perfect experts to be talking about institutionalization of cryptocurrencies for sure. So just a few pointers for the webinar in case you get disconnected. Just make sure you click on the link again to rejoin. The webinar is being recorded, so we will share it with you in an email. And there's a Q&A session at the end of the panel discussion, but feel free to post your questions along the webinar, and if it's relevant, I will try and bring it up during the panel discussion, else it'll be answered by one of the panelists right after. So starting with introductions, well, I'm Mriganka. I'm one of the co-founders and the CEO of Merkle Science. In terms of my background, I started my career in investment banking. Before Merkle Science, I used to work for a cryptocurrency exchange. They're called Luno. They're across Africa, Southeast Asia, as well as Europe. So while I was there, of course, a large part of cryptocurrencies was interacting with regulators, and I've literally seen the landscape evolve, or at least the Asian landscape over the last 3 years, where instead of regulatory ambiguity, right now there's a licensing regime and regulatory clarity on a lot of crypto assets. So it's definitely been very exciting to see that. In terms of Merkle Science, what we do at Merkle Science is detect, investigate, and prevent crypto crime. So we're based in Singapore, and we have offices in Tokyo and Seoul, as well as Bangalore is our development center. We provide blockchain forensic services for law enforcement agencies, blockchain transaction monitoring tools for banks, as well as financial institutions and blockchain intelligence agencies. And we also have intelligence reports, which we give out on ad hoc basis based on some investigations you have, or as part of your FATF compliance process, where you need to do due diligence on cryptocurrency companies. So these are the different segments we work with. So I guess that's enough about Merkle Science. Perhaps what I'd like to get to next is maybe talk about some of our esteemed panelists and their backgrounds. So Irfan, maybe I'd like to hand over to you, and you can start with a background about yourself and State Street, and then we can proceed with Stephen and Henry as well.
Sure. Thanks very much for having me today. My name is Irfan Ahmad. I'm a vice president at State Street. I've been at State Street now for almost 6 years. Prior to that, I spent about 2 or 3 years at Barclays Capital, working in various functions across big technology. So run the bank and build the bank projects. I joined State Street in December 2014 and landed into our global markets division within a function called business architecture. So that gave me a good grounding as to, I guess, how our global markets businesses operate from front to back. I was then fortunate enough to be able to go around the company and learn about what we're kind of better known for in the custody and fund administration space. And I worked in strategy, product development, and sales roles within that kind of rotation. And across Hong Kong and the UK in the main. I found myself moving out to Singapore last year. So I've had a year of 2 halves, as it were, in terms of the experience of being in Asia. So my primary remit now is to represent the digital product development and innovation team, which has been around for about 3 years or so, with a primary objective to explore and understand how digital assets and the underlying technology might disrupt our operating model. So with that in mind, what we're trying to do is understand what the institutional appetite is for these assets which have emerged and caused lots and lots of people in both the press and outside to warrant the amount of headline space that they've been able to get. So yeah, my team is actually global, and I'm the first of our group to move out to Asia to explore this space. Glad to be here.
Great. Perfect introduction. Stephen, we'd love to hear a little bit about yourself as well as Fireblocks.
Yeah, absolutely. Thanks again for having me. My name is Stephen Richardson. I'm Vice President at Fireblocks, leading product strategy. A little background on myself. Prior to Fireblocks, I was with Accenture Strategy, focusing on financial service institutions around customer and digital. So innovation within large FIs as they look to launch new products and understanding how product development looked on their side. Where open white spaces were for new product entry, as well as examining broader ecosystem plays for large financial institutions and their incubation arms. Previous to that, I was with a startup called Noble, where I led product strategy and general strategy for that firm, doing settlement and clearing for digital exchanges and financial services trading firms. So been in the space and in the digital space since about 2016, and like others have mentioned, have seen the space evolve over quite a long period of time. In terms of Fireblocks, we are a secure digital asset infrastructure company focused on providing leading technology to financial services firms, institutional firms, to be able to not only custody their own digital assets, but to be able to think about moving those digital assets in a secure manner between counterparties, right? And our real focus is, ensuring that basically there is a robust infrastructure for our customers to be able to use to expand on their capital markets use cases, whatever those might be. So think about, market making firms, exchanges, leading custodial firms, banking firms, payment infrastructure, or payments companies. Our job is really to provide, digital asset infrastructure for the support of all those different use cases, and to work to kind of build a collaborative ecosystem whereby which, there is a highly networked component and a highly networked ecosystem for digital assets, both, natively digital and the new emerging tokenized digital assets to be able to, be distributed and traded amongst all these different capital markets players. So I'm very excited to be on this panel today and discuss the topics at hand.
Perfect. Yeah.
Hi. Yes. Well, my name is Henry Chong, and I'm the CEO of the Fusang Group. Fusang also says that we build digital infrastructure for digital assets. And very specifically, what we mean by that is we operate the Fusang Exchange, which is Asia's first fully fledged stock exchange run for purely blockchain-based assets. So we can support the listing and trading of real securities, digital equities, digital bonds, etc. Support full-fledged IPOs and allow retail investors to trade in those digital assets. And we also provide all of the asset servicing around that. So we act as custodian, we do AML KYC, for example, on behalf of issuers. We support the issuance process in terms of taking, let's say, a traditional share, creating it as a blockchain-based instrument, keeping blockchain-based cap tables and everything else that goes into that. And we started with Fusang as our first and best test case. So we've taken 100% of the shares of Fusang Corp, the parent company of the Fusang Group. We have issued them as fully digital securities. So not a token that is backed by a paper share somewhere, but where the digital token is the share certificate. And we keep a fully blockchain-based cap table and register of members. And we're obviously looking to do this for lots of other issuers and for lots of other kinds of securities, which I guess is a little different from a lot of people in the digital asset space, because we focus a bit less on what I call digital native assets like Bitcoin. even though we do trade those, that's not really our primary focus. Primary focus is around providing services to digital securities. And as part of that, spend a lot of my time interfacing with various regulators across Asia. And I spent a great deal of time looking at the legal and compliance aspects of digital securities. So would love to explore some of these things more on this panel.
Perfect. Yeah, I think we definitely have the best set of panelists to talk about our topic today. With that, I'd like to get started. So the first questions actually, I'd like to direct it to Henry actually. So what the US OCC's letter for banks and like allowing federally chartered banks to custody cryptocurrency. So could you maybe start by telling us a little bit about this and what do you think the impacts would be on the cryptocurrency industry as a whole because of this, as well as institutional interest into the space?
Yeah. I'm probably not the best person to answer that question specifically because we actually spend very little of our time looking at US and US-based assets. I guess what I will say is that a lot of regulators across Asia have been quite happy for banks to do this for some time, trust companies, etc. And I actually think that the barrier so far is less regulatory and more legal, which we'd love to get into as well, in terms of the nature of what these assets are, the legal relationship between custodian, investor, etc. But at least for Fusang, as I said, you know, our real focus is on digital securities. And most of the regulators we talk to across Asia all say the same thing. You know, if this really is a security, if you're telling me that this is a share, I don't really care about the technology you use to represent it, as long as you can convince me that you have followed all of my usual securities laws, whatever, do what you want. What regulators have never said is, oh, because you have new technology, because you are doing digital, sure, I will magically relax some of my rules because you have different technology. I found, unfortunately, that regulators usually will look at new technology and try and figure out what existing box they can fit it into, right? They'll say, what does this look like and where should this go in terms of my existing regulatory structure? And I think that is just the reality of how things are in the regulatory environment. And I would recommend that all people start thinking in that mode of how do I fit into existing structures?
Yeah, no, I think that's definitely relevant. And yeah, Stephen, we'd love to hear your thoughts around that as well.
Yeah, I mean, I think there's a lot there to be agreed with. I think we've been working with folks that are thinking about things with BaFin, right? And as they think about tokenizing digital securities, the question is more regulatory than anything else. There's not a lot of a question around the technology that's being used to execute that and whether or not they need, you know, kind of a technological or regulatory approval in order to do so, but rather whether they follow the rule of the law. Now, I think from the OCC guidance perspective, what I find really fascinating about that is, you know, there is a point of view that generally speaking, to issue that type of guidance, a bank that is, you know, nationally chartered must have gone to the OCC to get, you know, this clarifying information, right? Which means there is the exploratory basis by these banks outside of what you see from just more of a pilot perspective to potentially look at something that is a bit more commercial, right? And to kind of potentially be on the leading edge of what folks like Nomura have done with Kamanu and Standard Chartered has recently announced with what they're doing here in Asia. So I do think that provides, you know, a little bit of a spurring moment for other banks that are exploring, you know, digital asset custody, whether they be more on the natively digital side like Bitcoin, Ethereum, et cetera, or more on the stable coin side, given, you know, the upcoming, Libra, right? And the fact around authorized resellers in the Libra ecosystem, more stable coin issuance, what you're hearing from folks like PayPal and Visa in terms of what they want to do from a digital asset perspective, and whether or not banks that generally play, you know, broader custodial, you know, plays would be allowed to really interact in this ecosystem. And then more from a retail bank perspective, if you're looking to really engage with different forms of payment and different forms of money and capture wallet share that you would think are starting to go towards, you know, Robinhood and Square and PayPal and all these alternative services, whether or not you yourself can get involved from a banking perspective. So, you know, it'll be very interesting to see, you know, in the next few months or, you know, quarter to quarter and a half, you know, who was that first kind of player and what that does for the guys that are, or for the folks that are, you know, exploring custodying digital assets and the use cases that would support that, and whether that triggers them to, you know, really put their foot on the gas as to not let someone accelerate with market share too far ahead. So I think that's a pretty interesting, you know, development for the space.
Yeah, and I guess from my part, I probably echo what Stephen and Henry are saying with regards to some of the historic barriers to entry that that have been observed in the market, especially from an institutional standpoint. So the news from the OCC in a way is very encouraging. It's not really wholly surprising, given that Brian Brooks, former Coinbase, is at the OCC and is in a position to be able to influence the way in which a regulator views this kind of space as it develops. You know, there are lots and lots of crypto or digital assets. I guess you'd call them evangelists that have made the move over to the traditional side. So crossing back across the Rubicon, as it were, to try and purvey how this type of asset class might develop and the structures and regulations that would enable institutions to readily wade in and diversify their portfolios or actually kind of give the, I guess, the traditional custodian space a little bit more comfort into providing services around these types of assets as they grow. But I think the other thing to maybe mention is that, and this is something that Henry had touched upon before, regulators across Asia Pacific have been very, very much, I wouldn't necessarily say leading the charge, but they've been a bit more progressive in terms of the styles of thinking they have around this, whether it be from a licensing perspective or whether it be from, say, for instance, if you look at the Thailand's digital degree, whereby they've actually gone about and you know, set about the challenge of digitizing their entire economy inside of the space of 3 years. So these types of steps forward are really important for the industry because they demonstrate a couple of things. One, that the pace of change isn't letting up, and two, that black swan events like the one that we're living through at the moment will certainly accelerate what we're seeing in the institutional space. So whilst the OCC announcement is clearly important, I think that there are many more important announcements that are about to be hitting soon. So to Stephen's point, where he mentioned that, you know, that the guidance is probably in reference to a national US chartered bank that are looking to get some more guidance from them, I wouldn't disagree. Typically, guidance like that doesn't come out without some sort of prompt.
Right. No, I think that those are definitely very valid points. Well, Irfan, considering the State Street's global footprint, and you did mention even the team that you work in is global, and you were one of the first people stationed in Asia from there. How would you say the regulatory guidance, I mean, you did touch upon it to a certain extent, but specifically in some Asian countries, how would you say the regulatory guidance maybe varies as compared to Europe or the US? And has that really led to more institutional adoption in Asia, though?
I'd say that the Asia Pacific, it's not just geographically disparate. It's also, from a regulatory perspective, quite disparate as well. So the way in which, say, for instance, regulators from our vantage point have observed the way in which they would treat digital assets is quite different. I guess the way that I would view some of the more mature traditional jurisdictions like Hong Kong, Singapore, and Japan, they've taken the view that they should be able to try and fit in digital asset regulation and licensing into almost the current type of structure. So some might say that that kind of leans towards the traditional securities players being given almost an advantage in terms of providing services and products around digital assets. It's a real mix. Thailand, Taiwan, China, Australia, they've all taken slightly different tacks in terms of how they look to approach the regulatory aspect of digital assets and really making them an institutional type of offering. And I think once we get to the point where there is far more harmony from some of these jurisdictions as to the way they treat some of these assets, so whether it be property, whether it be currency, whether it be an asset, that will have large implications for the models in which we'll have put forward for, say, for instance, the safekeeping and custodizing of those types of assets too. So it's not an easy question, and I don't think we're going to get a ton more clarity in the next quarter. But beyond that, as we kind of fine tune and the regulators start speaking to one another about how they would look to kind of provide further guidance, it'd be really interesting.
Yeah, absolutely. I do agree that referring to Asia Pacific as a whole, they're actually very disparate, and each of them have their own variations. Where I think here in Singapore, it's regulated more along with the Payment Services Act, which is more a payments regime. But in other geographies, they actually make a separate provision for the asset class rather than considering it as a payment type. Well, you did talk about custody and some of maybe the security challenges. I guess my next question would be to Stephen. So what do you see are some of the biggest technology as well as the biggest infrastructure challenges that are faced in terms of institutions getting into this space? And how do you see that evolving going ahead as well?
Yeah, so I think there's a couple of different things, right? I think if you look at most of the use cases that have been executed so far by large FIs, obviously in the natively digital space, folks are leading the charge. But from a large FI perspective, most of what you've seen has been in pilots with R3 or one of those other providers in a more incubator or incubation phase, right? And as folks are starting to think about what that expands out to, there's still the issue of really understanding what are the use cases, and in this environment, right, where allocation of dollars becomes important, right? There's still understanding what are the use cases within the digital space, that are worth really investing in. That's problem number one is defining the business case. I think problem number two is choosing the right either set of ecosystem partners or platform partners that would generally allow you to develop a multi-year business plan and business case to be able to execute, right? And so the question is, what are the right custodial partners to choose? What are the right folks that are doing tokenization? Are you looking at permission blockchains? Are you looking at more natively open and non-permission blockchains? And what does that mean? I think there's a lot of real questions in terms of, is there a platform or a set of platforms or an ecosystem play that can solve not what I'm doing just today, what I'm going to be doing in 2-3 years, such that I don't have to redeploy architecture or build brand new architecture to support new concepts that developed over a period of time, right? And I think security is first and foremost, right? Obviously, keeping the digital asset safe, keeping it within the right operational infrastructure, connecting it to legacy systems. But those are really challenging problems when you think about, broader operations that are happening within these large financial services firms. So then you have to then couple that with, did I choose the right platform? And so when you think about re-platforming any technology at a bank, right, that is a multi-year effort that generally has significant due diligence and is quite expensive, right? And so, there is something to be said about, when you talk to banks and when we go and meet with banks and we're thinking through this, what are the right platform plays? do these platforms, connect in such a way, right? Or do they view themselves as opening up to non-permission blockchains, and all these different things? And so I think that's been, to be honest, one of the biggest challenges that we've been working with financial institutions on is really understanding the business case, and then understanding how they can implement technology partners that help them not have to go through this restructuring exercise in 2 or 3 years as the market matures, right? And I think that's been a big thing for folks.
And Stephen, I think that really resonates, because when you look at the type of undertaking that you're asking of a banking institution, where they're custodying, or they're holding a certain amount of assets that are legacy, and the types of processes and underlying apparatus that they have, and you ask them to then shift to something completely different, which is somewhat unproven in terms of the size of the market. It's a big ask. It's a big investment, and to your point, it is multi-year. So that challenge is really something that we're thinking about very deeply, in terms of how we would look to do it, how we would look to kind of push. What are the business drivers? What are the specific processes that would be eliminated in terms of movement through this? And like Henry had spoken about before, it's not a consideration of a like-to-like change. It's a complete rethinking of the way in which you do business, in the way in which you process certain securities. The rules have to change. The apparatus have to change. It's wholesale. It's not upgrading a CRM or any other kind of modular system. It's the whole network.
Right.
So Irfan, when is State Street going to start providing digital asset custody?
I was actually timing as to how long that might take for one of my co-panelists to bring up. It's an interesting question. So we've been exploring the space for a little while, and as of yet, we haven't really seen the wholesale demand coming from our primary client bases of asset owners and asset managers. So as you may know, that's our kind of natural playing space. That's where we tend to get a lot of our drivers from a product development point of view, and we really haven't had that in large swathes as of yet. Whilst they're kind of still experimenting and still in the POC states, there's not really the commercial drive to really push it through. So at the moment, from what we can tell, it's not something that we would embark on, or at least build ourselves in the near term.
I actually think that echoes with what we find as well, in that even when people speak of institutional demand in the digital asset space, they often mean what I call digital native institutions. And in terms of total volume coming from traditional institutions as an actual percentage of their own asset base, I personally see, at least in Asia, it's still quite light. A lot of people are beginning to explore, beginning to test, but it's still quite sort of two different groups of people. And the institutions that I do see trying to start exploring this space often will set it up as a whole new vehicle, right? They'll set up a digital asset focused sub-fund, etc., purely to do digital assets. But my personal feeling is that until you have these bridges that can allow traditional institutions to seamlessly get in and out of this market, it's going to be quite difficult for them for exactly the reasons you mentioned. Nobody likes having to lift and grip the entire infrastructure just for what a lot of institutions consider to be a couple of trades.
Yeah, I mean, I think to that point, and I'll kind of reiterate, I think what I believe will be the driver of a lot of this, to be honest, will be the payment space. That's my my personal view around folks that will then start to build a use case for your traditional custodians to more broadly engage. Sorry, the light in my office just went off. But yeah, I do think if you look at your PayPals, your Squares, you look at PayUs in Israel, you look at quite a number of these folks, they're quite keen and quite interested in doing some things that would require a set of ecosystem partners in order for this to be executed. And I think as we've talked with banks, I don't think there has to be, or at least my conversations have been, I don't think there has to be, the potential for, a massive home run to be executed right away. I think what they're generally looking for is a set of partners that enable them to scale over time to then support that massive growth in the second, third, fourth, fifth year, but a business case today that allows them to, continue past what I'd say that incubation phase into a real life commercial opportunity, right? And I do think, as we start to think about what Libra does, as we start to think about, what the likes of will happen with PayPal, as we start to think about, multiple different on-ramps that are starting to occur in the space. Obviously CBDCs, this starts to give folks, a gentle nudge towards the commercialization of, digital asset custody and digital asset business cases with pure FIs. And I think, it requires a rethinking, like, Irfan mentioned, of, how has the natively digital space evolved? How are folks playing in it? How are folks like the Jump Capitals and the, Cumberlands of the world and Jane Streets, how do they operate? How do they operate differently than they do in other traditional markets where, they have to rely on traditional custodians, whereby which they've already built this custodial infrastructure themselves, and what's required for them to make that shift over to move their assets to a State Street or to move their assets over to a BNY Mellon or to a Standard Chartered, right? And those are, big questions that I still think are left to be answered and require, folks to think, I think, a bit more creatively in the space. So it'll be exciting to kind of see, where that ends. But I do think that payments companies will drive banks to start to push, even on just like a on-ramp, off-ramp component or a conversion-based component for merchants, right? They will start to, push banks in that direction. I think, if not at the end of Q4, beginning of Q1.
Yeah, no, I think that's definitely a valid point, especially with CBDCs. That does give potentially like companies like State Street the push to maybe enter into custody and other business lines. But one thing I'd love to hear from all of you, actually, either your individual companies or your clients, how do they go about dealing with regulatory ambiguity? As with every new technology, there would be a lot of regulatory ambiguity here with multiple instruments out there, right? So would companies, would financial institutions try and utilize the regulatory ambiguity to their advantage and get in as a first mover? Or would they shy away from it because of the regulatory ambiguity, or how would they go about dealing with this?
Well, I'll just say no one wants to be Libra 2.0. Okay, so that's just a fact of life. I mean, they got smacked down pretty hard, for not paying attention to, or at least taking what I'd say is a fintech-ish view towards regulation. And in the case of money movement, like that generally is not looked on too lightly. I do think that folks are engaging with the regulators and asking for the right levels of clarity, and generally trying to do the right things, right? I think you have the folks that have kind of stepped out on the edge. Again, I use the more Standard Chartered as an example, that are doing that. And I think that, if you look at BaFin, for example, and what folks are doing that with the upcoming deadline in November, you really start to see which firms are, have been engaging with the regulators and what they're doing and what this means. As we've engaged in those spaces, we understand that those regulators are not afraid of technological innovation, right? They're really, they're really not opposed to it. And so, I think folks have gotten some level of comfort with being able to understand which regulators are enthusiastic about digital opportunities and which ones you might need to more cautiously work through, right? I think from a technological perspective, JFSA, right, with the regulation around cold storage for digital asset custody, is something that tends to be a little bit more difficult given, the use case around capital markets, right? And what that means for operational inefficiencies and all these other things, right? So while they are forward thinking in some ways around STOs, from a technological perspective, at least as an infrastructure provider, there's some things that we're continuing to push on, to enable our customers to be able to do, actually execute the business cases that they want to do. So, I do think that no one is looking to, be put in the spotlight again, like, we saw earlier, and they're doing a lot of back channeling or through their lawyers to make sure they properly understand, where the regulators sit at the moment.
No, I completely agree. I don't think big financial institutions are willing to operate in an environment of regulatory uncertainty. Where we've been able to move forward with projects, with issuances or listings, it's because we've been able to go see regulators with those institutions and get specific approval from regulators.
And I think it's probably fair to say that regulators themselves are looking to be educated. So there's been a number of consultation papers that have been coming out around the world in which they're actually eliciting feedback from fintechs and financial institutions themselves as to how they are thinking about what would be the appropriate model or the appropriate approach that should be taken in order to be able to protect consumers and operate in the most transparent manner. So I think it's a combination of things. So I don't disagree with anything that Stephen or Henry have said previously, especially around the Libra 2.0 comment. Not an enviable position to be in at all. But I think it's about bringing regulators on the journey. So if there is substantial demand from the institutional asset class, from the institutional players within financial markets, they themselves were going to the regulators for guidance. So if anything were to be ambiguous, as you called it, that's not something where regulated institutions will want to play, because you're just on a hiding to nothing. And so for custodians and for traditional players like ourselves, we need to have that guidance in order to be able to have a mandate to provide services. Because otherwise it's a can of worms that you really would rather keep shut.
And I would also just add to say that regulators are institutions too, and like a lot of traditional institutions, they also don't want to stick their neck out and make blanket statements. They don't like approving things, is my experience, especially with a lot of Asian regulators. But if you go see them with a specific project, they'll say that they don't not approve. Not quite the same thing, but at least that's usually good enough, right? Like a statement of no objection is usually good enough for the institution. But I think it's a bit optimistic to expect regulators to come out and issue sort of sweeping blanket statements and say, yes, that everything is okay. They'll come back with the standard refrain of, okay, well, here are my principles, and I'll look at this on a case-by-case basis.
Right. So yeah, I think Henry brought up a good point. The don't not approve. I think what I was trying to check about is that sufficient for a bank or a financial institution, according to you, to get into the space? Because I think the statements are more like, we have no particular stance on this at this point, so we do not approve. And but with that. And that is going to constantly be a problem with this industry, because there will be aspects of technology which come up for the first time round. So do you actually see that institutional adoption is almost 5 or 10 years away rather than 1 or 2 years away, as a lot of maximalists tend to say?
Well, sorry. Yeah, just to add, I think there's a big difference between we don't have any stance and actually being willing to issue a letter, so an explicit, communique, but saying, yes, we have no particular issue with what you're doing, right? Regulators aren't about to stamp and say, yes, we support your product. That's just not how they operate, right? They'll say, yep, what you have presented to me looks fine, right? There's no issue with it, but who knows? It might change down the road if you go and do something naughty, right? There is a very limited set of financial market products that regulators are really willing to say, yes, I have authorized. usually public products, dealing with retail investors, with prospectuses, etc. But it's no different than if I had a private hedge fund, right? They're not going to approve my fund. They'll just say that, yes, we have evaluated and you can proceed. We have no particular issue at this time.
Yeah, I mean, I think we have to put like context. I mean, if you're looking at like cryptocurrency and total market value at 300+ billion, someone like BNY custodies 37 trillion dollars, right? So, when they're thinking about market products, right, and to go to a regulator and be in a space of ambiguity, right, where that can jeopardize their business, context, the reallocation of resources, and all these things, right? It's important to understand, what would be the driver of having someone go there. I don't think it's 5 to 10 years away. Again, I don't think it's that far off. I think, it's a year or two away to really build what are the first use cases that emerge out of these incubation cycles. What are their opportunities that, these banks feel comfortable engaging with, folks that have gone through the regulatory cycles to actually engage with, truly digital assets. And then is there the kind of the spurious demand from your largest customers, whether they be asset managers, et cetera, to actually engage in the space and to push it forward. And I think, that is still upcoming. I think it's within the year or year and a half. I don't think it's 5 years away, but it's again a business case decision that I think the digital asset space has to overcome for these traditional FIs.
I'd also just add that I don't entirely agree with the premise that institutions have to enter the market first, and then because the big institutions say it's okay, and that retail money will come later. I actually think that in many cases it's the other way around. Institutions don't want to trade against other institutions, right? If there is significant and substantive retail flow, that's usually when institutions start saying, this is interesting, let me pay more attention. And so I completely agree with the fact that, yes, right now the market cap is just not quite big enough for large institutions and custodians to dramatically reallocate resources. The substantive retail flow is not quite there yet. Right? It's big enough that if I'm a crypto native institution, it's interesting. But I agree, if I was a Bonnie Mellon or a State Street, I'd say, interesting, I'll keep my eye on it. But compared to, let's say, global equities markets, volume, volatility, especially right now, I've got a lot of other things to worry about.
I'm not really sure whether I have to add to that. In terms of I don't really know what else I can say on top of that. It seems as though for us, I guess, as an institution, we see this as an interesting space, but until we have the mandate from our largest clients that they would want to actually go forward, that's really the driver for us. What we are seeing is that there are I guess instruments that look familiar in the traditional space that are starting to emerge, like PB platforms, like swaps, like options, like futures, forwards, these types of things that will enable a institutional client to hedge out their positions will try to, I guess, entice institutional adoption. But again, some of the points that we've raised previously around regulatory ambiguity, the fact that that's even still a question is should be evident enough for institutions to kind of wade carefully and take on an exploratory type of view, as opposed to kind of jumping in with a whole suite of products and services that will that may or may not be used by institutional clients at the moment.
Yeah, absolutely. I think in that sense, I think we've clearly seen the evolution, and nobody wants to be Libra 2.0, and this is clearly a financial services game rather than a tech play. So most of, the statements around Facebook's move fast and break things don't apply here. I think definitely liaising with regulators is the only option in taking them along with the journey. Well, I do think that one of the key points, that's always raised when there's talk about regulations is the FATF AML guidelines and the travel rule. So maybe from Henry's perspective, as a custody provider or as a player in the space, what is your opinion on that, or what are your views on that? Do you think to a certain extent that's over regulation, or because in some ways the regulation came about even before there was ample technology or clarity on how to solve the problem?
Mm-hmm.
So how would you view the FATF guidelines and the travel rule?
I think it doesn't matter what I think. It's about the reality that you can and will have not just FATF, but KYC and AML guidelines worldwide. Like it or not, that is the world in which we exist. And even 18 months ago, long before FATF imposed the travel rules specifically on digital assets, we started operating as though we would have had to comply, because I thought it was an absolute inevitability that this would come in. But I guess the flip side of it is that, I think we're not as bothered by that as some, players are in this space, because so much of what we focus on naturally requires identity to be linked to the token. The minute you have any kind of security or non-digital native asset, right, that exists somewhere else, and you have an instrument that is fundamentally backed by another asset, you can no longer have it as a bearer instrument, right? The world of bearer shares is long gone. Almost by definition, a share is a share certificate or a token, if you will, plus identity. And those two things together effectively make up ownership. So we've always had to track identity for most of the assets in which we support. So for us, I guess that's a little less of a problem. I think the question arises around digital native assets, like let's say Bitcoin, where, I guess the open question is how much of the demand there is driven because of the lack of things like the FATF travel rule. And if more and more providers started implementing these rules, whether some of the use cases would begin to dry up.
Henry, question for you. So in terms of, we've seen over years, we've seen much a big shift, right, in terms of direct to indirect holdings and for indirectly holding assets. In terms of what we're seeing now, and you mentioned before that you spent a great deal of time in terms of the legalese around this. What do you think is kind of the thought process, or what do you see as the emerging thoughts from policymakers around the how the law treats immaterial digital objects?
I think that's a fascinating question, actually, because that's something we spent a great deal of time looking at. We actually convened a digital asset project at the University of Oxford almost 2.5 years ago now. Initially, first to look at the question of whether or not digital assets are property. A lot of people spend a lot of time talking about regulation and compliance, but that's half, right? The other half is the law, which is not quite the same thing, right? If you exist in a common law jurisdiction, like I guess a lot of our firms do, the law is made by case law, right? By judges and courts making decisions, quite separate from what regulators can decide by fiat. And certainly around things like the Mt. Gox case, that was a huge issue that I think is dramatically underlooked, where the court initially said, as far as we can tell in the Japanese law, these things are not property. If they're not property, they can't be owned and they cannot be stolen. Therefore, move along, nothing to see here. Now, I think most jurisdictions have come around to accepting that these things are property. It's a complex discussion, so I don't want to take up too much time looking at it. Certainly, the UK has convened a task force that effectively said, yes, come on, these things are property. Even though they are a novel form of property, everybody treats them as though they are property, and really, why not? But I think it's still an open question in terms of looking at some of the resulting factors. So for example, not a lot of intermediaries that we interact with have thought about questions like, if I'm acting as custodian, on what basis am I actually holding these assets? Am I acting as a trustee? Can this be a bailment? Which in my opinion, it can't be, or what else? And you know, a lot of people who, let's say, buy some Bitcoin off a lot of digital asset exchanges, if you actually go and dig into the terms and conditions of these exchanges, you'll find no mention whatsoever of those relationships, which is fine until something blows up. And inevitably, that's when new case law gets made. Something blows up, something goes wrong, people go to court, and then, you know, inevitably the intermediary argues, oh, actually, no, I wasn't holding this on your behalf. These are my assets, and too bad, go away. And again, I think that not a lot of courts and jurisdictions are sympathetic towards that view. And more of them are coming down to decide that, for example, yes, they can be the subject. They are property, that digital assets can and should be the subject of a trust, for example, and that intermediaries should act accordingly. And I guess to bring it back to my point right at the start of this panel is that, like it or not, regulators can and will extend their current reasoning into novel assets, right? The FATF, no surprise, say, hey, I applied the travel rule to traditional money. You, the industry, tells me that this should be like money. So, okay, here you go, travel rule. We see the same thing around securities, right? Regulators say, okay, well, I have securities laws. You tell me you've got some cool new technology to have digital securities, fine, follow my rules, right? And as long as you can follow the existing rules, I don't mind. Obviously, the conflict comes when, because of new technology, it's not always easy to implement those new rules. But again, like it or not, that is just the reality that financial institutions have always had to navigate. So I'm not sure there's anything new. And I actually haven't seen many regulators come up with decisions that I would call surprising, right? A lot of people complain that they're slow, but I actually think that that's unfair as well. You know, if you look at this, I'll give you an example, you know, cloud computing, right? Or anyone who's worked at a financial institution knows that it took them, you know, maybe 10 to 15 years from the inception of cloud computing to allow the biggest financial institutions to go full cloud. I think they're actually moving significantly quicker on the subject of digital assets. Certainly out here in Asia, in just a few years, a lot of regulators have begun at least to start looking at rules around these assets. And in many cases, as I said, are actually quite open to having discussions if you come to them and present use cases to them. Yeah.
Perfect. Great, guys. I think it's been a great panel discussion. Well, we started off talking about the US OCC, and thereafter we did move into maybe the regulatory segments of it, talked about how like Asian regulators tend to be far more innovative in some ways than the others, and net regulatory clarity and is definitely a big positive for the industry. And then I think Irfan clarified about how maybe Irfan and Stephen as well did mention that the biggest drivers for the space might either be direct business drivers from either retail or payments would tend to be a big push for this industry gaining institutional adoption. So all in all, of course, and even with the FATF travel rule, it's pretty much standard. It is in line with financial services, and irrespective of whether it's convenient for the industry or not, it is here to stay and will probably lead to a net benefit because there's just more regulatory clarity, and as institutions come in, they would feel safer coming in with the things like the FATF travel rule or proper AML CFT guidelines in place across different geographies. There is an interesting question, so maybe I'd be happy to hear the view of the panelists here. So what is the view of the panel on the adoption of digital assets in APAC, maybe specifically Singapore and Hong Kong, versus the US and Europe?
Do you want to direct that to anyone, or is it a free for all?
It's a free for all. So whoever wants to take it up, I'm happy to hear their views.
Sure. So let me have a first crack, and I'm sure Stephen and Henry will have much more learned and educated views than myself around this particular subject. So I guess in Asia Pacific, and let me just bring up the question so I frame it correctly. The adoption of digital assets in APAC versus US and Europe, in particular within Hong Kong and Singapore, something that we've mentioned whilst on the panel is that there are regulatory sandboxes that have been set up by the regulators in those particular jurisdictions. So Singapore and Hong Kong are no different, and in fact they've had a really forward-thinking way of being able to bring innovative companies in, provide them a safe space, I guess, to experiment, provide them with the various scenarios and use cases that would be relevant in the real world, and then giving them space to run. That's true in the UK for sure, from the FCA and what they've been doing with their regulatory sandboxes, and I think the same is true maybe in the US as well. However, I don't really hear too much in terms about what they're doing around, you know, this idea of sandboxes or digital asset labs in the US. That's not to say that they're not doing it, but those types of things will help with at least showing adoption for institutional types of clients in the future. I think it's probably fair to say that hedge funds, family offices were kind of the first institutional movers in this space, and they tended to emanate from the US and Asia. I didn't really see a lot from an adoption standpoint in Europe, but I may be wrong.
Yeah, I would agree there. I mean, I think when you look at the US, you know, when you talk to folks like the FCC, they've, you know, not wanted to issue any guidance around digital that they think would have implications that they don't yet understand, right? So they've been, I think, very cautious. I think the OCC, obviously, the reason it's such a big thing is this is kind of like the clearest guidance so far. And then you have folks like NYDFS, right, that have been engaged in the digital space for institutions in New York that are, you know, I would say are pretty much on the forefront of, we're on the forefront of kind of like the digital space in the state, on the state side. I think one point I'd like to kind of point out too, I look at more from like a retail adoption level, because I think to Henry's point earlier, the retail is going to propel the institutions to, you know, I think provide liquidity in these different spaces. I think when you look at it, like you look at places like, you know, Japan and Korea and others, right? Those represent some of the largest, you know, FX plays and spaces in the world. You look at the GMOs of the world, et cetera, right? Digital asset adoption and trading was like relatively high. When I was 2016, when we were looking at it, you know, volume significantly out of like Japan and other spaces were, you know, quite a lot larger than we were seeing within the US. And you know, that was just a very clear view, right? So digital adoption, digital innovation along those lines, you know, has been something that has pretty routinely been adopted here in comparison. If you looked at Europe, everything was like CFDs, right? It was like traditional products that you weren't really necessarily custodying a digital asset. You were doing something with, you know, IG or, you know, one of these other guys for a CFD to get exposure to the markets. And then you had, you know, the stuff with, you know, in the US, right? And so, you know, I think that it wasn't really even taking a hold of physical delivery of Bitcoin. It was more, you know, on the synthetic basis, right? And so, you know, I do think that, like, you know, in terms of people's understanding of the digital from a retail perspective, my personal view in terms of, you know, what we saw in 2016 from trading volume perspective, as well as other things, you know, led me to believe, like, at least from a retail perspective, you know, there was more adoption here in Asia and more appetite to, you know, look at tokenized digital currencies, you know, tokenized native currencies, and then, you know, looking at tokenized securities, you know, bonds, treasuries, et cetera, right? I just think there's just more familiarity with that concept. Therefore, the regulators have been more open to engaging with sandbox environments that would allow the progression of this to occur. And then I think you're seeing more market-making firms and trading firms that are engaging in the space and then propelling folks to then push this forward, a la, the need for custodians like, what we're seeing with Standard Chartered and Nomura, right? And I think that all makes sense given where the retail adoption has been, and the fact that you're not seeing it on the US side is on the base of you're really only looking at Coinbase, you're looking at your ICE and others as basis of getting digital assets, and then you're basically relying on, from a retail perspective, PayPal, Square, and Robinhood as other bases to get exposure outside of things like Grayscale Trust, right? So I think, when there is more kind of like solid demand, I think you'll start to see it catch up. You'll start to see the sandbox environments open up. But I just think that's a matter of just how, aggressive retail was in 2016, 2017 here in Asia compared to what I think, was taking place on the US side or even Europe side.
I actually think the answer to APAC versus Europe is China. No secret, China is the world's biggest adopter of digital currencies, right? Not blockchain based, but everyone pays for everything in China with digital currencies. And certainly in the just over the last couple of weeks, there's been a flurry of activity, not just around, obviously, central bank digital currency, but around blockchain based assets in general. And I think no big secret why, right? As US and China tensions increase, I think China is extremely keen that even if it doesn't control what is potentially the next generation of a settlement network, so to speak, at least it's not controlled by someone else. So I actually think that, China sometimes is a bit of a walled garden. So people outside of China don't always talk about it as much as they should. But if you look at Ant Financial's, Ant Chain, for example, there is real and substantive use for that. And I suspect that China will be by far the leader in the adoption of digital assets generally in the years to come.
Yeah, absolutely. I think those definitely, like, not just China, but as well as Japan, Korea, and now Singapore and Hong Kong. Singapore, relatively newer in the markets, would definitely be the future of cryptocurrencies going ahead, perhaps, along with the US. So there is an internal question, which I also thought was quite interesting for the topic here. So one of my colleagues from Merkle Science was keen to know what the panelists think about CBDCs. And do they see any opportunities, or are they planning to get involved with that in some ways going ahead? Or how early do you see it happening? And do you see business opportunities there as well?
And maybe we can answer quickly. I think they're inevitable. Yeah. China obviously has a lot of a push factor in terms of being first, but inevitably other countries can and will follow suit. Two main reasons. Number one is that fiat currencies are owned and controlled by their respective government. Governments today struggle to impose monetary policy because it doesn't always work as they hope. With a digital currency, you have a far greater degree of control in terms of, for example, imposing interest rate changes. And the second big reason is that, as we've been talking about, like it or not, we exist in a world in which every asset, for all intents and purposes, the receiving institution needs to know where it comes from, and you need to know who the UBO, the ultimate beneficial owner of the asset, is. And having a fully digital currency will allow for far greater traceability. And my personal suspicion is that as blockchain-based asset adoption increases, you will have more transparency vis-a-vis the regulators rather than less, which I think is actually the opposite of what a lot of people who are today investing in, let's say, Bitcoin imagine.
I agree. I think one other interesting, topic to think about is, we've heard a lot about like stable coins and kind of, all these other things. I think if you look at business cases of like retail banks, large retail banks, not your, large institutional global custodians, whose business models are different, the CBDC currencies provide them an opportunity to really like engage in the market, because from a capital charge perspective, they would potentially be applied differently, right? Like you're not holding cash and then, you know, leaving that cash, right? It's actually coming from a central government, which means that it can be then used, borrowed against, you know, used in capital markets products use cases, right? And that becomes an easier entry point for them to think about what are some of the capital markets cases that they can then execute on top of these CBDCs. So if you look at what's happening with France and the banks that are involved with the CBDC projects there in Banque de France, you look at what's happening outside of that, like I think these provide, I'd say, a gentle nudge in the direction where you know, I think folks thought the easiest use case was just, you know, custodying of cash and issuing a stable coin, right? Not necessarily recognizing capital charges allocated to that, you know, this CBDC currency would allow them to do some other interesting use cases without having to venture on their own to start thinking about that infrastructure for tokenization and digital fiat issuance, right? And really then leveraging what's being done from, you know, a central bank to be able to then execute, you know, blockchain related projects. So I think that becomes a really interesting thing and could spur a lot more of like the retail focused, you know, banks to do some other things in the space.
And not only is it inevitable, but it's coming quickly. So I think in terms of the types of central bank digital currencies that you're seeing develop, so both wholesale and retail, I think that there is a lot of thought that's being put into both of these types of structures, or these two-tier systems. So the BIS, they did a survey across 66 central banks and found that 80% of them were either participating or had live projects around central bank digital currencies. So I think it would be remiss of any financial institution to not be paying attention to how this might develop and what it might mean to their business models, irrespective of whether they're retail or institutional, because it's going to have an impact. In terms of the settlement systems and the way to be able to monitor and control various policies, and for them to be able to pull levers and have an immediate effect is also incredibly important for central banks. And so, as I say, I think it's inevitable, and it's probably sped up by current circumstances. The other thing that I might say is that it doesn't necessarily need to be on distributed ledger technology. There are a myriad of ways in which you might be able to implement this type of solution. China has, you know, as Henry alluded to, you know, leapt ahead, and they've actually demonstrated that there are certain portions that will enable them to be able to use distributed ledger technology, but they're not reliant on it. So I think it's an interesting point in time that we're at, and I think in the next 6 months or so, we will start to see you know, the broader adoption from other central banks outside of the 66 that were surveyed by the BIS. The other thing to maybe take note of is that fiat's not going away. Even if one person has demand for physical currency, it will be there. So it's not like you're going to eradicate the usage of fiat. It's going to be there, and it's going to be there for a very long time.
Absolutely. So I guess that brings us to the end of the Q&A session. And we're also slightly over time. I'd like to thank all the three panelists for their insights on the topic. And there were some very great discussions here in terms of the participants and the attendees. We'll send you a recording of the webinar. But in case you do have any questions specifically for the panelists or for Merkle Science, feel free to just write in to us and we'll forward it to the right person as well. With that, any other closing statements, Irfan, Stephen, or Henry? And yeah, I think we can close off our panel discussion. Thanks a lot for attending, the participants as well as the panelists.
Well, thank you very much.
Thanks for having us. Appreciate it.
Thank you. Have a nice day, everyone. See you.